good morning, or good afternoon, depending upon where you are right now. Thank you for joining us for this discussion, which is entitled ESG, Pro or Con, the Devil's Advocate Conversation. My name is Joe Diaz, and I'm a managing partner of Lytham Partners, LLC. I'm joined today by Jamie Bechtel, founder and CEO of Kito Impact, a leading ESG consulting firm providing guidance to medium-sized and small companies, both private and public. Kito Impact brings decades of experience to the table for public and private companies to deliver appropriate corporate social responsibility and environmental, social, and governance metrics as this movement within the institutional investor community and other stakeholders continues to take hold. Our firms, Kito Impact and Lytham Partners, are collaborating on providing companies in this market cap sector the best possible advice and product content to meet whatever ESG needs they may have. Today, we're going to focus our conversation from the perspective of small cap public companies. Jamie, thanks for lending your expertise to the conversation today.
Joe, thanks so much for having me.
The idea of ESG reporting within the public company sector is not new. It has historically been focused on mega cap and Fortune 500 companies. However, in recent years, medium and small cap companies are increasingly being asked about the ESG reporting initiative. There's a great deal of uncertainty within this market cap space. In many cases, management teams and board members don't know what to do or where to turn. Jamie, how do you see this developing in the coming years?
It's a great question, Joe. It's been, I am sure, as all your listeners and viewers know, a very dynamic time in the ESG space. And the big companies have had ample runway to get used to this, to wrap their heads around it, and frankly, wrap their businesses around it. I've said for many years, there's a lot of good people working in the capital markets, and there's a lot of people involved in ESG for good reasons, but most of them are there because it's also good for business. And as you mentioned, we're starting to see this press down into the micro caps, and there's less resources in that space. And so folks are really struggling to understand what it means for their business and how they can get involved. I think many are still saying, how can we avoid this? And that avenue is closing rapidly.
And as it relates to avoidance, it just isn't going to happen. From what I see, there is just a flood of information coming forth from institutional investors wanting more information, different stakeholders for private companies wanting more information. I have the sense that this is here to stay, and some people, whether they like it or not, are going to have to come to that conclusion sooner or later.
Yeah, I've been asked quite a bit with negative news with ESG investing that's been out in the past few weeks, if this is the beginning of the end. And I kind of joke, no, it's actually the beginning of the beginning. You know, it's a much more mature market. So there's criticism coming in, and that will only strengthen it to move forward more aggressively.
From your perch, where do you see this criticism coming from? Who is pushing back against this as far as you can tell?
It's interesting. There's a couple of different sectors that it's coming from. So most of the recent criticism has been around ESG investing. And so regulatory agencies are starting to say, wait, how are you actually defining ESG companies in your portfolios? Because the investment firms are trying to respond to the customer demand. And that's the key. That's what we have to remember is the investing firms are putting together these indexes because there's demand for them. And that demand does not show any signs of slowing down. And so regulators are asking, how are you defining these metrics? There's, very diverse monitoring across sectors, across the different agencies. And so there's still a lot of, it's still a pretty dynamic system. But what we're seeing and where this will ultimately drive it is alignment and rigor. And I have been really encouraging my clients to wrap their heads around this, where we're at now, so that when the mandates start coming in, when the audits start coming in, folks are prepared, that it's not a knee-jerk reaction to what's inevitable from our perch.
I think that that a lot of the smaller companies feel that this could be a hurdle for them to continue their innovation or to bring new innovative companies to the market. Our institutional investors that are kind of pushing this, unwittingly saddling small companies with additional costs, stretching of their limited resources that will possibly impact their gross margins and their ability to grow. Are they unwittingly bringing something to the table that might hurt the small cap sector?
So I think it's like any regulation where there is potential upside. If you're looking for the hurdle, if you're looking for the downside, you'll find it. But there is a lot of opportunity in ESG. And for companies that are well positioned, avenues open up very regularly. New market segments are available. I was just talking to one of my clients about the Green Climate Fund and the hundreds of millions of dollars that are being invested in these markets in building new supply chains. And there are very few corporations there ready to act. And the ones that are acting are really, delivering on their value for their shareholders. And so it's not just about the regulation, it is about driving employee performance, it is about meeting customer demand, and there's tremendous upside. And again, that's why the big players are doing it. It's not because they're there to save the world.
You had mentioned the regulators. Is there a possibility, or maybe as part of the game plan, that regulators will begin to mandate some of these ESG initiatives? Is that something that will go from being voluntary at this point, maybe being mandated by regulators and or the government?
Absolutely, they already are, Joe. So for example, the California human trafficking law, companies of a certain size who are either based in California or do business in California have to respond to that. That's part of an ESG portfolio for sure. NASDAQ's new diversity disclosures of not only people of color, but gender, that's regulation in essence. And the EU, it's important to remember, is well ahead of the US in regulation. So any company that's looking to expand markets, those regulations are out there and they'll continue to grow. But again, ESG is very broad. And so there is ample room to respond from the position of your company to kind of get out there in front of it and self-define right now, so that when the regulation comes, you're prepared. It's a tweak as opposed to a huge investment that you have to make. It's, essentially, we're talking about future-proofing companies, and the time to do that is now.
And I think that there is a real fear about the cost factor that all of this entails. And again, because there's a lack of knowledge, there's probably some fear. They probably don't really grasp what kind of a cost they're looking at. Can you talk about how these types of initiatives can be engaged in a cost-efficient manner?
Absolutely. I think, Joe, if we're going to be honest about this, we have to be honest about consultants generally. And they tend to come in and, with sticker shock, scare the heck out of any CEO who's trying to get a multitude of things done. And the ESG sector is no different. There are very, very expensive ESG experts out there, and a lot of the big firms are sucking up the ESG talent. So there's a real talent crunch right now. Our firm was established especially to come in at that lower price point. But the reason we did that was less about price and more about authentic change. We come from an impact place, from the we did want to make the world a better place, and we do want to make the world a better place, but there's a way to do that very cost effectively. And so you're seeing more technology, ESG reporting and databases, software that's emerging that will help keep costs low. So there are ways to do it, but I think that the best thing a company can do is think of this as an integrated process to think of it as everyone in their C-suite, everyone in their board should be thinking about how to incorporate ESG and what the win for that individual, that particular office in the C-suite is. So if you're the CFO and travel is reduced and people are offsetting their carbon, you're going to save money. If people are having to determine whether that conference is worthwhile or not, the pandemic has certainly helped with that, to keep people on Zoom, which we don't love, but it saves carbon. So there are ways to integrate it and to have everybody thinking about it a little bit, as opposed to a big outlay of cash and energy and resources in a lump sum.
Right. A lot of this stems from a platform of quote unquote doing good. It seems to me that doing good can be in the eye of the beholder. What one party considers to be good, another might not believe the same. It seems somewhat subjective, but the definition of doing good sort of seems like it might be dictated by a small group of investors, which frankly then makes it a requirement. Is that a process in democracy, or how is this idea of doing good being accepted out there?
Yeah, so it's interesting. Again, you have to remember, while the investors are, as they often are, the loudest in the room, the real underlying motivation has come from the customers and from employees. And that is what continues to drive. And so making sure you're establishing your ESG metrics with your stakeholders in mind, and setting that stakeholder group quite broadly, then yes, there is an element, and that's what the system is trying to determine, is to remove some of that wishy-washy and bring rigor, which will make it more difficult to implement. But there are pretty good resources out there, and there are some things we can all agree on. Should you have human trafficking in your supply chain? You should not. Should you be reducing your carbon footprint? I think even naysayers this year. In fact, I'm not sure who's left. Insurance companies certainly know. The military knows climate's a problem. The power companies know. We all know that it's a problem. We need to start addressing it. And I have a couple of nonprofit clients, and I've been on their case that you don't get a free pass on carbon just because you're a nonprofit. So there are norms and standards that are out there. This last year with Black Lives Matter, and what does diversity look like in the workplace, and why does it matter? It matters because it's really good for business. It's incredibly important to have diversity of thought. Now, how you define diversity, I have some clients that have offices in Japan, and their definition of diversity is very different than what we might have here in the States. So the opportunity is for companies to go in and self-define on some of these areas so that they are ready for the reporting as it comes down, and to have a voice in the debate. Right now, if you're not involved in ESG, you don't have a voice at all. So,
right. As it relates to the ESG ratings themselves, I've spoken with people that are saying to me that these are quite variable, they're inconsistent. Some of them lack perspective or context. Some of them have asked me, is this essentially a marketing scam? How would we respond to that type of a complaint?
It's a great question. And frankly, a lot of ESG experts have come from marketing. Historically, ESG was housed in the marketing department. That has changed because, again, social media, transparency in the system, your risk is higher because your chance of getting caught is higher if you're doing something that is outside of an ESG norm. And so there is steady movement toward authentic implementation, of making sure that, we are rising to the challenge across the board. So, yeah.
Yeah. You had mentioned that there has been some pushback in the past few months against ESG in the EU and in the US. You said this is just the beginning of the beginning. For the small cap sector, the idea of supply chains and working with their supply chains to affect change could be a daunting idea for them. Again, how can they do this in an effective manner and meet the goals that they're trying to meet in that regard?
So it's important to remember that, especially in climate, but in all ESG, you really have a series of scopes or spheres of influence, right? So climate is very well defined. There's scope 1, 2, and 3. And even the players who have been in it for 20 years are trying to figure out those scope 3 emissions. That's the supply chain. And so that's the bigger, longer picture. You can get scope 1 and scope 2 emissions under control in most sectors very, very quickly. And frankly, if you get them under control as a startup, you're golden, because you're built that into your accounting system from day one. It is so much easier to just, and the pandemic has created an incredible opportunity. We're all grounded. We're redefining what business looks like. And so again, I work with a lot of clients who are trying to get those policies into place now before people start heading back into the offices. So in all of ESG, there are the steps that you can do today, right now. Set up a whistleblower hotline. And that seems like such a dumb, small thing, but think about what happens if you don't have a hotline and you do have dangerous conditions. If you're a good leader, if your staff matter to you, you want them to be as safe as possible, and you do want people to report dangerous conditions without being fearful of losing their jobs. It's a no-brainer. It takes 10 minutes to set up a whistleblower hotline. There's plenty of third parties willing to do that. And that's a big check off the ESG to-do list. Now, when you get down to those more nuanced pieces, it takes a little bit more energy. But by that time, you've already shown good faith that you're moving through the system and you're managing your company with good intention around these issues. So I think the biggest problem, Joe, and frankly, the greatest opportunity and the most exciting thing is people are freaked out by ESG and they don't even know they're 50, 60, 70% of the things they're already doing. And if they're not already doing it, it's pretty easy to do, or it's something that we're going to do anyhow. So most of this is a way of thinking and a way of speaking and a translation of language. I have never had a client that was not 50% or better on ESG metrics, especially, Joe, especially publicly traded companies on the G. Forget it. You can't be a publicly traded company and not. You're going to get caught by the SEC on much more important things than ESG at the moment. So that's the key right there is you're already doing the work. You're turning in the homework, but you're not getting credit for it. I have a 14-year-old son. This really resonates with me right now. So I apologize for the analogy, Joe, but it's the same. You're doing the work, get the credit.
Absolutely. And I think that's where I wanted to be heading toward. Most public companies are already providing the information. They just need to package it appropriately. They need to lay it out appropriately where it can be received by the constituencies that are looking for it. What are the easiest things they can do to make sure what they already have in their filings can be used on their website or other types of communications platforms to get their message across?
This is something that's changing, and it's changing for the better, and it's going to make it easier for folks. It used to be a big corporate social responsibility report. You've seen them. Nike has a beautiful one. Apple has a beautiful one. And that's kind of fading out. And now on your website, you're in your investor section, which everybody here I'm sure already has. You have an ESG section, and you're really making those policies and procedures available in a very organized and consistent way. And you're including key factors in those policies and procedures. And so many companies already have that, but you want to make it accessible. It's just like credit ratings. It's so much like credit ratings. Half the time you're being assessed and you don't even know it, and your information isn't in an organized, accessible fashion. And I know, Joe, you've heard me say this before. So I think making that information available, making it organized, knowing what to put, so that the analyst can breeze right through it, and knowing how to mitigate it. Same thing on a credit rating. If there's something you don't agree with, then there's back and forth. Maybe there's some mitigation on your part. Maybe there's some, it's a give and take. So it's not a dry cut right now. There's a lot of room to maneuver. It's about being organized and understanding, what the customer and the employee is looking for.
So it's really can be a simple matter of having the information in your filings, having that information on your investor page, your website, having the information and earnings releases and things of that nature where people have easy access to them, correct?
That's correct. And you are going to see a push from regulators to include the information in annual statements, in quarterlies, to begin to see a merging of the financial statements with the ESG statements. So it will become leaner, it will become easier. But again, that's the starting place. And I really encourage companies to, think about there is upside here. There's tremendous upside. That's why big companies spend big money on this.
Yeah.
And so look for those wins. I always say 70% of this is workbook. Do you have everything in the right place? And 30% is strategic opportunity. Where are my new market segments? Where are my value wins in the system?
Sure. Let me take a step back. You had mentioned scope 1, scope 2 in terms of the energy component. Give us a little bit of detail on that. I fear there isn't any real understanding, that a lot of people are afraid of that. What can you tell us to just give us additional information and arm us for handling this appropriately?
Absolutely. Scope 1 and scope 2 I'm almost horrified to tell you how easy it is to deal with them. Scope 1 is essentially what energy are you generating? It can be, if you're an oil company, how many emissions are coming directly from your business. And it can also be, do you have leaky refrigeration and you're releasing some noxious gases there that contribute greatly to climate change. Scope 2 is how much energy do you use in the course of doing business. And to be honest, mostly it's looking at your electric bill and figuring out how many kilowatt hours are in your various departments. And that's it. It really, you can download all of these sophisticated spreadsheets, but that's the nuts and bolts of it, is how much, carbon are you emitting, and how much carbon are you using? And in some cases, we've run multinational corporations scope 1 and scope 2 emissions in a matter of hours.
Right.
The trick is the baseline, because you do need to set a baseline. You do want to do some benchmarking in your industry, and you want to improve against that. And what customers and employees are asking for now is intent, Joe. They want to see that you're intending to be a good company. We did see through the pandemic, PwC just released a new study that actually the numbers kept climbing for customers and employees who want to see their company doing good environmental work, caring about the environment, caring about social issues, and moving forward. So it's up to 83% of customers and 89% of employees are demanding companies do better.
In your experience, where are you seeing the biggest amount of pushback on this whole ESG thing? Is it from really the smaller companies, and what is pushing their concerns or fears regarding ESG and becoming more compliant?
I don't think, frankly, unfortunately, the microcaps and the smaller companies don't have a unified voice that they're able to push back with. Mm-hmm. Where we're seeing, which begs caution for the microcaps, is one in impact players. So in nonprofits, they're really arguing that ESG is a smokescreen and that we need to move toward regulatory. And so the more we push back on ESG, the more play they get in that regulatory space. And then we're seeing a lot of regulatory pushback for ESG investing. Again, if I just combed over the last few days through all the headlines for the last 4 months, and it's really on that investing. When you bundle these companies, is that index really selling what it purports to sell.
Mhm.
But we are not seeing, any pushback that indicates that, this is something you can dust off and push off to tomorrow.
Sure. Are the exchanges the part of the regulatory regime that are starting to get more activated and asking for more compliance on an ESG basis?
Yeah, so that's exactly what's going to happen is they're going to start demanding alignment around these standards to remove some of that variability. There's only so many directions it can go in. We know how to measure carbon. That's not going to change. How you report it, that press for transparency, that's what's going to change. Human trafficking in the supply chain, we know how to measure that. We know how to assess it. We know how to get rid of it. That's not going to change. It's how and where and when it's reported. So in these big indexes, what's happening is companies are self-reporting, and there's a lot of concern by regulators that self-reporting is not enough.
Right. Well, this is a huge topic. We're just beginning to scratch the surface of it. Jamie, I want to thank you for spending time with us today on this. There's a lot going on in this space, and I'm sure it's going to accelerate in the coming years, particularly in the medium to small cap company sectors that we operate in. So we thank you for your time, Jamie. And if you are on the management team of a public company or a board member, I would encourage you to contact me directly by phone at 602-889-9660 or email me at diaz@lythampartners.com. That's DIAZ at Lytham, LYTHAM, partners.com. We will be pleased to focus the expertise of Kito Impact and our firm Lytham Partners to make your ESG reporting efficient and effective. So thank you for your time. Have a great day.
Thanks, Joe.
Thank you.